Hey everyone, this is Logan Hertz with Hazeltine LLC. I thought today we'd go over one of the more overlooked benefits of the first lien HELOC that I really believe in, but it's something that the calculator actually doesn't take into account, and it's something that is usually foremost in my mind that I want to show here today, which is how simply by running your cash flow through the HELOC, even the money that you spend can actually be working for you. So let me give you an example to show you what I'm talking about. So this is a sample case, and I'm not going to go through all the details here. You can go to another video if you want to see the basics of how the first lien HELOC works. But this is just a $300,000 mortgage in this example. So a $300,000 mortgage with 3.5% interest over here. You can see they're a few years into it versus a $300,000 first lien HELOC with an 8.8% interest rate. In this example, this hypothetical client has $12,000 of monthly income and $5,000 of monthly expenses, not including the housing payment. Because once you replace your mortgage with a HELOC, you no longer have the housing payment. And then we have homeowners insurance and property taxes. And in this example, by replacing your mortgage with a first lien HELOC, and this mortgage you're 6 years in, but by replacing it with a first lien HELOC, you pay off your house in about a little under 4.5 years. Uh, the equivalent 30-year amortized interest rate would be 1.3%. Okay. And we've been through this before, but I want to jump into something a little more detailed that this calculator is actually handicapping the first lien HELOC. Okay, the first lien HELOC actually helps you more than what this calculator is showing. So as an example, let's just take a look at this table here. So let's just look at the first month. So in the first month, the HELOC, you're going to pay more in interest, obviously, because the HELOC comes with a higher interest rate. So in the first month, it's saying you're going to pay $2,200 towards interest. And then every month after that gets better, as you can see, as the principal comes down. Okay. But that's not actually true. You're actually going to pay less in interest. Okay. The only way you would pay this $2,200 in interest is if not just your starting principal balance was $300,000, but your average daily principal balance for the first month was $300,000, which I'm pretty sure will not be the case. So you're actually going to pay less in interest, and you're actually going to pay this off faster than what's illustrated here. And let me show you how. Okay. So now I'm going to flip to another spreadsheet that I built. Okay. So this is John Smith. Okay. So remember, he has monthly income of $12,000. Okay. In this example, I'm assuming he gets paid on the 1st and the 15th of the month. So $6,000 comes into his bank account on the 1st of the month, and $6,000 comes in on the 15th of the month. Okay. And then his expenses come out on the 28th of the month. Okay. Now, obviously, everyone's situation is a little bit different, but you'll see how almost regardless of your situation, the amount of interest you're going to pay is going to be less than what the calculator is actually showing. And if you want to really take advantage of the first lien HELOC, what you should do is change all of your bills, or the ones that you can, so that they're paid as late in the month as possible. Okay, so your starting principal balance is $300,000. Okay, but remember, you're charged interest not on the starting principal balance, but on the average daily principal balance, which in this example is actually $291,300, which means the amount of interest you pay is not $2,200, but actually $2,136.20. And that's just in the first month. Okay, if you were to calculate this all out over a number of years, it could make a big difference. This could make a big difference. So how is it that we're actually paying less in interest than what the calculator is showing? Well, the calculator is deliberately being conservative, right? The only way you would pay $2,200 in interest is if your principal balance stayed at $300,000 for the whole month, which meant you had no income for that month, and therefore your principal balance didn't go down at all. Okay, so but what's actually going to happen is you're going to dump your $6,000 of income at the beginning of the month. Your first $6,000 hits on day one. Your principal balance immediately drops to $294,000. Okay, then it stays at $294,000. Okay, and then on the 15th, that remaining $6,000 drops in. So your principal balance drops to $288,000. And your income stays in the HELOC for most of the month, right? So for 27 days out of 30, your principal balance has been reduced by your income. And then on the 28th, $5,000 of expenses comes out of your HELOC, and therefore your principal balance goes back up to $293,000. Okay. And then eventually you would also make that interest payment. Okay. So what this is showing you is that unless all your income comes in and all your expenses go out on the same day of the month, which is very unrealistic, you're actually going to be paying less in interest than what the calculator illustrates, because your income is going to be sitting in that HELOC for some amount of time before your expenses come out. So even this $5,000 that you spent, it sat in the HELOC for a few days before it came out, right? So you're paying less in interest. That's illustrated. So the average daily principal balance is not $300,000, but $291,300. And that is what you're actually charged interest on. So without you changing anything, right? Just by you running your cash flow through this much more efficient vehicle, you're getting some great benefits. So in this example, this $5,000 of expenses that you're spending, if you have a standard checking account, that $5,000 just sits in your checking account for maybe a couple of weeks, and then it comes out and gets spent. That's it. That $5,000 did nothing for you. In this example, and that's what the calculator shows, that $5,000 did nothing for you, but that's not realistic. In this example, that $5,000 is doing something for you, right? Because for 27 out of 30 days, it was sitting in your HELOC, which meant it reduced your principal balance by $5,000 for 27 days out of 30, which means it reduced your average daily principal balance by almost $5,000, which reduced your interest costs, even though you spent all that money. So this is an important point to make, that in the calculator, we're actually handicapping the first lien HELOC. It's actually going to look better than what's illustrated. And you could get very granular on this depending on when your income comes in and when your expenses go out. You know, you could make assumptions and see what it would actually cost you, and it would be less than illustrated. So that's an important point to make. So if you're trying to optimize your first lien HELOC, if you're in charge of when your income hits your bank account, which you're usually not, you want that to hit as early in the month as possible. But usually you have some amount of control over when you pay your bills, right? And you can pay them as late in the month as possible. That way your income sits in your HELOC, your float, as they call it, is as long as possible. And so just by, again, optimizing your cash flow by how it flows through your HELOC, you are reducing your out-of-pocket interest costs and increasing your equity gain. So I hope this was helpful. Thanks so much for watching.